Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. For solicitation or to buy or sell any security, either the host, guests, or clients of either may own securities discussed on this podcast. Welcome to another episode of Special Situations Cast. Today we have a very special guest. It's Corey Hoffstein. Corey is the co-founder and chief investment officer at Newfound Research. He has a background in computer science and actually co-founded Newfound while still studying. Corey, correct me if I'm wrong. Newfound Research is a quantitative asset management firm, as you may have guessed already. And Corey's first focus is on managing risk. Newfound primarily works through trend following, but I guess we'll be talking about that a lot. Hi, Corey, welcome.
Great to be here. Thank you for having me.
Oh, it's my honor. Hey, I introduced you to the listeners, but I love it if you could tell us how you got started as a quant and how you managed to start your own firm, like straight out of college.
I would like
maybe
to.
whether you recommend that for.
We got our start back in August 2008 as a firm, which in hindsight ended up being a great time to start a business. At the time, I don't think anyone thought starting a business mid-financial crisis made the most sense. I would like to say I had some grand ambition for this business, that I knew exactly what I was doing. The truth of the matter is I had been working on some quantitative models myself. You mentioned that my background was in computer science. I actually was a self-taught programmer going way back to like 7th grade. I always envisioned myself making video games for a living as a young millennial male. I thought that was the ultimate career ambition. As I went into college, I ultimately said, I don't think this video game thing is for me, but did get interested in finance. And I started to apply my programming and computer science background to the world of finance. And really, again, for me, risk is just a very intrinsic part of my DNA. I've always been much more focused on the risk than the reward. So a lot of the initial models and research that I was doing was on ways to manage risk. And so I developed some unique dynamic trend following models that I was applying to different ETF portfolios. And through my father's financial advisor, was introduced to a local asset manager who asked if he could license that data and research from us. So we spun up the company. I was a broke college student looking for some beer money. Ended up going to graduate school at Carnegie Mellon to pursue my degree in computational finance, which is really just a financial engineering degree. I assumed I'd go work on Wall Street doing sales and trading of credit default swaps or something like that. Clearly, that path didn't be the way I ended up going. But while I was in grad school, the appetite for these sort of risk-managed ETF portfolios really grew in the industry. And I had always had sort of the entrepreneurial bug. My father was an entrepreneur, so I always knew I wanted to take a step into running my own business one day. And I said, there's a real opportunity here. I have this firm that's somewhat established. It's creating some cash flow. There's a real growth in the market here for this type of strategy. Let's see if I can hit the ground running. And 12 plus years later, we're still here.
Yeah, well, congratulations for surviving.
Thank you.
It's an accomplishment. And so you right away in college, you must have found some stuff that worked, or were you lucky, or?
Well, I think you think luck always plays a role into it. I think what's interesting is coming from being so naive in college, I think there's a real advantage to being naive sometimes, which is you don't develop preconceived biases into the way things work. Naive can also work against you because you don't understand the actual dynamics. But I think for me, it allowed me to explore with open eyes a real breadth of different types of models with no preconceived notions as to whether they should or shouldn't work, no judgment. And so for me, I just ended up landing upon trend following without even knowing it was trend following, and finding that it was very successful for what I was trying to do, which was meaningfully participate with growth of an underlying asset while reducing drawdowns. I ended up developing models that were sort of a unique form of trend following. So very traditional trend following says, hey, let's buy those assets that are going up, sell those assets that are going down. And normally, sort of the academic studies would say, well, we're going to look at sort of a fixed horizon of how we measure whether an asset is going up or down, right? We might look at the prior 12 months of returns or the prior 6 months, or we might look at whether price is above or below a 200-day moving average. But that whole system is built upon this idea that we're measuring based upon our clocks, right? That we think the market is somehow driven by our clocks. And my core concept when I was building the models that I was building was, well, the market doesn't move relative to our clocks. The market moves relative to information flow. That if there's some big event that unfolds, then that's going to change how prices move within the market. You know, sort of that old adage of you can have sort of a week in a day type experience, or a whole year can occur in a week type experience. And so what I tried to do with our trend following models was say, I don't want it to be static. I don't always want to look at the last 200 days. I need a model that's more dynamic, because as we see more of that information flow into the market and have a larger impact, we probably need to shorten up our window because that old information isn't as relevant. Conversely, if the market's going nowhere and it's really slow and stodgy and there's no real meaningful information flow, we probably just want to actually slow down our model. And so the whole sort of core philosophy is we always want to be looking at a constant amount of information, not a constant amount of time. So that was, I think, for me, a real unique innovation in the way we manage our models. But at the end of the day, they are sort of at their core trend following models.
Okay, so let me just summarize it, see if I understand. Hopefully it helps listeners. So trend following sort of needs to see an established trend, or traditionally, and you differentiate yourself by being able to very quickly catch a trend. And then it sounds almost like you did a kind of a Bayesian way of figuring out, is this really a trend or not? And then you increase your maybe sizing or confidence.
Yeah, exactly. There's a bit of a statistical confidence to it for sure, but I think really the very simple way of thinking about this, and you actually see this in the high frequency space more, is if you were to go plot something like a Tesla stock price over time and you look at a chart, most of the time it's going to be sort of what those candles, right? An open, high, low, close every day. Well, what if you, instead of looking at it daily, said, let's create candles every time 1,000 shares trade, or 10,000, or 100,000, or however many shares you want? Well, now all of a sudden, if no shares trade, you could have a candle that lasts a week. If thousands and thousands and thousands of shares trade within the same day, you could draw 5 candles in a day. No longer are you tied to the market calendar. And so this idea that the real innovation that we tried to incorporate 12 years ago was saying, let's move ourselves away from this time-based trend following system and move ourselves into a domain, a sort of measurement dimension that I think is actually going to be more consistent. And so for us, it was incorporating things like volatility and normalizing price trends and that sort of stuff that allowed us ideally to try to say, look, we're trying to look for that, again, that constant amount of information flow coming into the market, not a constant amount of time.
Yeah, okay. It sounds like real straightforward or logical if you explain it like that, but I've never...
The devil's always in the details, right?
Yeah, and then maybe it's really challenging because it also sounds complex, and then you sort of have to figure out what am I adding that actually makes my stuff better and what's really detracting from it. So I think you have a lot of work.
Yeah, you know, it's interesting when you explain it. I think when I do explain it to people, a lot of people say that makes logical sense. But again, implementation is always difficult, going from sort of some theoretical concept to how you're actually going to measure these things. And then the reality is that at its core, regardless of how much you really add those, I wouldn't call them bells and whistles, but make those distinctions, this is still a trend following system. So when trend following doesn't work, it doesn't necessarily mean that this approach to trend following will work. Yes, I think there is an edge in this type of trend following, but at its core, it's still going to be tied to the performance of trend following.
Yeah. And let's see, like trend following, it to my understanding, and I don't know very much about trend following, is that just like value investing, it's sort of had a difficult decade, maybe.
Yeah, it really depends on how you're implementing trend following. There's all sorts of trend followers, but sort of your average commodity trader has had a difficult decade. I think a lot of money piled into the approach after 2008, where these trend followers had a really strong 2008 and had exhibited a really strong prior decade or 2 decades. Really showed themselves to be strong diversifiers to equities, as well as potentially delivering crisis alpha. So I think arguably the holy grail, perhaps, right, of a diversifier within a portfolio, but really have struggled since to deliver meaningful returns. Now, there's all sorts of arguments as to why. And again, it's highly dependent. You see a huge amount of dispersion in performance between trend following managers because the approaches they take can be so different. But as a category average, it's really struggled. Our particular approach has not been to do the traditional commodity trend following where we're trading in futures and we're trading equity futures, rates futures, commodity futures, or currency futures. We actually stick to just trading equity markets, with the idea being we're trying to create a trend following equity exposure that can participate as equity markets go up and try to preserve capital on the downside as equity markets decline.
Right. And so you already mentioned kind of that trend following is a great diversifier in like the traditional portfolios. And my understanding is that it works especially well if you have sort of a longer term bear market, not so great like in March or something. But then
I think intuitively, right, just by the name, if there are trends, then trend following is going to do well. When you see the market make sudden reversals, right, at those times of change, and especially rapid change in the market, trend following is going to be delayed. And then if you see back-to-back rapid changes, right, so we saw the market run up in February, make a steep drop into March, and then a steep reversal into April, you get what's called whipsaw, right, which is you're sort of trading at exactly the wrong time with your trend following. What's interesting to me about trend following, right, is again, there's a whole breadth of different trend followers. Some that can trade very fast. Some trend followers are actually intraday. They do all their trading and then by end of day close, they're actually out of the market entirely. And some are very slow. They're looking at 9, 12-month signals. We tend to verge on the slower side, sort of 6, 9-month type signals on average, maybe as slow as 10 to 15 months when things are really slow in the market. And for those types of signals, you really need to see trends that last a quarter to 6 months in time. Having a 1-month rapid sell-off and reversal, even for like a dynamic model like ours, is just too fast.
Yeah, because you do something with volatility or other signals, like now we're adapting faster.
Exactly. So we saw in March, our signals adapted to the fastest speed they ever had in back-tested or live history. So prior to that, 2008 was the fastest speed they had ever moved. This eclipsed 2008 almost, I think, by 50%. So if our prior fastest speed was, call it, I don't know, 100 days, this went down to something like 50 days, and which is incredibly fast for us. I mean, normally we're looking at windows that are 300, 250 days in length. And again, dynamic, but on average around there. So it spoke to the speed with which the market was moving in March. But even still, again, when you get a sell-off and a rapid reversal, you're going to end up selling late and then buying in late. And, obviously difficult for a trend follower to navigate.
No, it was super difficult for a fundamental investor as well.
Not enough time to make fundamental decisions either.
Exactly. I was really experiencing like I need to have like more research ready to deploy in times like this, because you can't do it in time.
Yeah.
Also was real interesting. And I think this also leads us into important things that you know a lot about. But first I wanted to talk about your recent quarterly letter, because it was kind of remarkable. and you kind of said we were wrong. We had the wrong approach, and you're basically saying that clients told you the market has changed, something's up, but they couldn't really articulate what it was, and you couldn't find evidence of a real change in the market. But recently you've reached a different conclusion, and I was really interested to hear about that journey that you went through and what your conclusion was.
Yeah, I'm surprised compliance let me publish that letter. I don't think compliance likes you saying we're wrong in the asset management industry, but and you don't ever find that, right? Normally, at least in my view, if you do think you've taken the wrong approach, it certainly doesn't breed confidence among your investors or new investors.
No, I don't know. Do you know like Tatlock, the research by
Yep.
Tatlock? Okay,
Yep.
like, and he's all this research about people who predict the future, and that the experts who get invited are always the most strong, biggest opinions.
Yeah,
But,
the strongest opinions. Yeah,
right.
absolutely. So it's not great from a marketing perspective, though I will say the feedback to that letter has been incredible. I think maybe perhaps just because it was a breath of fresh air in the industry. But to your point, so we did publish this quarterly letter. The journey getting to that quarterly letter goes back probably 6 months, really started in March 2020. But again, to what you said, it was even prior to that where I started to have clients. So I work mostly with financial advisors who buy our strategies either in sort of a separate account or mutual fund format, who started to say to me, it feels like markets are different. It feels like we are seeing these rapid sell-offs and rapid reversals much more than we had in the past. Has something fundamentally changed? And I couldn't find quantitative or qualitative evidence that made me feel like markets truly had changed. I could take what was happening in US markets and find other periods in the past in US markets or other periods in international markets where I said, this is just sort of part of the way markets can act. Doesn't necessarily mean things are fundamentally different. And even if markets are different, right? Because they're always different. The way markets operate today is very different than the way they operated 25 years ago. It doesn't necessarily mean that the fundamental tenets by which we want to invest should be different. Cut to March 2020, and all of a sudden I'm watching the market first ignore this massive exogenous shock that is the COVID-19 virus, right? We see January and February, US markets seem to completely ignore it. And then it seemed to rapidly and violently price it in a way that as I was watching in real time, I said, this exogenous shock has now turned into this endogenous liquidity event, that we're having these violent unwinds among all these players in the market. People are hitting risk limits. This thing has now gone on way too far and too fast. And then all of a sudden you got this really strong bounce. And so sort of in the fallout of March, I said, all right, let's pretend for a moment I have not been a trend follower for the last 12 years. And I don't have this complete bias in me of being a trend follower. Can I try to reapproach markets and figure out what is the puzzle piece that I'm missing? And so I went on to write this piece called Liquidity Cascades that was all around these sort of contemporaneous narratives that I've heard around what is driving markets today. And I'm sure we can get into that. But ultimately, my conclusion was, wow, I think there is sufficient evidence here that we're going to continue to see events like February 2018, December 2018, March 2020, but also 2017 with its abnormally low volatility. I think that's just as symptomatic of all the underlying drivers as the crashes have been. And so with that in mind, this sort of suggests that trend following is not going to be as effective as it was before. While these sort of issues remain at play. And so for us, it forced us to go back to the drawing board and reinvent how we were going to try to create resilient all-weather equity type returns.
And the reason you would argue that trend following won't be as effective is because you expect these like sharp reversals more often. And then in between there's like a very flat market with little volatility.
Yeah, so ultimately what we would sort of expect to see is more tail behavior. So both in the right and left tail, that markets seem to be exhibiting greater extremes with greater frequency. And it's not that those extremes are happening in a way where there's strong trends prior to the extreme. They seem to occur out of nowhere and cause these rapid reversals. And that's very difficult for trend following to navigate. The traditional trend following answer is we'll just move faster, right? So we'll just keep speeding up and speeding up and speeding up so that at the first sign of panic, we can cut our risk immediately. The problem becomes when you start to go that fast, then you're just cutting risk all the time. And so you're never actually participating in the market. So in between crises, you're getting all chopped up and you're sort of slowly bleeding death by 1,000 paper cuts. And then you might get the crisis right, but you've already sort of bled out. And so there's this balance you need to find with trend following of being reactive enough to the types of markets that you want to see dynamic shift in your portfolio, but not so sensitive that you're making changes all the time that are costing you in performance. And so it was sort of our view that for the types of markets we're seeing, I don't think you can just keep speeding up. I think if you keep speeding up and if the whole industry keeps speeding up, it just sort of becomes this arms race that actually makes these effects worse.
Right. Yeah. I think we saw some of that because there were like a few days where the market went 5% in one direction, and then in the second half today, it went another 5% in that direction.
Yeah.
And I think it did that for like a week, and then you saw more of those reversals, and I think something changed again. It's real.
I mean, what was interesting to me in doing the research is that there seem to be like those types of effects that you're identifying, and this is all, I lay this all out in the paper, seems to be when those market sell-offs occur, there are a large number of systematic players that are forced by prospectus and mandate to update their portfolios, and they all do it in a very pro-cyclical way, right? So risk parity strategies start cutting risk. CTAs, managed futures, trend followers all start cutting risk. A lot of structured products after 2008 ended up getting tied. So things like variable annuities ended up getting tied to target volatility indices. They start cutting risk. You see option dealers who are facilitating or market making within the options market having to hedge more aggressively, and that becomes pro-cyclical. Levered ETFs have to hedge in a way that's pro-cyclical. So when the market moves down, it's not just risk parity that's selling. It's risk parity and managed futures and levered ETFs and option dealers, and banks are being forced to hedge, and they hit these different risk limits and they keep having to hedge more and more. And so you get this cascading effect that ends up being self-reinforcing, because as they start to sell off, they put more downward pressure on the market, which forces more risk management, further selling off. And so you get this huge washout until you get to a point like late March where most of these players had already sold everything. If you look at sort of historical positioning levels, you know, risk parity, managed futures, all these risk indices had delevered to a historically abnormal low level. And simultaneously, you hit options expiration. So a ton of the hedging that had to happen rolled off the books of option dealers. So all of a sudden, like March 23rd, right around there, was this reset point of there's no one left to sell. And so it's sort of in that context makes sense of, okay, of course we're going to start to see a rebound because no one's selling anymore. We've probably gone further than fundamental economic arguments could justify. We should see a bit of a reversal here. And then all of these systematic players, all they can become is buyers, right? That as the market starts to stabilize, all this money is going to start returning back into the market.
Yeah. Yeah, it's maybe interesting. What really hurt me this year, I was actually, as a fundamental investor, I saw the COVID coming pretty well. So in March, I was up like 10% or something. But then at the bottom, I was like short, like everything that I figured would have a real hard time surviving. And what it was long was like a lot of more idiosyncratic stuff. And so all that cruise lines, airlines that rallied in my face, like I think 100% or something, and
Well,
it was real strong.
I think that actually touches on a really interesting point, though, right? Which is prior to central bank intervention, would you have been wrong? Right? If all of a sudden central banks hadn't stepped in and said, we're willing to facilitate credit markets and we're going to, through these lending facilities, start buying ETFs that buy high yield bonds. If that hadn't happened, would companies like the cruise lines been able to survive? Right? So it's an interesting dynamic that's at play. And I talk about this a little bit in the Liquidity Cascades piece, which is, another big influence that's entered markets over the last 20, 30 years has been the role of central banks, which is they really went from a more passive referee to a very, very, very active participant, right? They took their entire playbook that they developed from 2007 to 2009 and rolled it out in a 2 or 3 week period in March, right? So brand new innovation in 2008, whole thing came out in 3 weeks, right? And so I don't like to call it a Fed put, but to a certain degree, when you start to say we're going to create a way by which these companies can now use credit markets to borrow and know that they can always get a buyer because these bonds are going to get included in an index that's getting bought, right? You're going to see huge high yield issuance. And that's what you saw in June. It's the highest high yield issuance ever, which allowed all these companies to survive. And so when you go from, by the way, they might be still complete pieces of shit after this as companies, but when you go from a view of they're going bankrupt to they're going to survive, the price that's right between bankrupt and survival, it can be, to your point, they can rally 100% on you. And so it becomes this interesting dynamic to try to navigate as a fundamental manager. You might have been completely correct mid-March that all those companies were going to go bankrupt if it weren't for central bank intervention. And this is not a moral argument for or against central bank. I don't want anyone to color it that way, but I think it's an interesting dynamic that as investors, we have to begin proactively considering in how we're building portfolios.
Yeah, I don't have like a huge moral opinion about it. I'm a little bit irritated. I do see like a difference between the large listed companies and like small companies, and maybe there are differences between countries. Some countries they get better care of the small companies than other countries, but I'm not sure what to think of that. Like how the performance of major the mega caps has been for a long time, and how much that's thanks to the central banks. That's maybe the one thing that gets me a little bit upset. But I'm not convinced. Like there are like two schools of thought about these central banks, and one is that when they act, it actually the only effect is confidence, so that like your clients, the financial advisors, regain the confidence of, okay, we can stay in the market, or that it actually like pushes up a price or.
I think there's sort of this conspiracy theory. I remember this from 2008. What was called the plunge protection team was sort of the joke, right? That whenever the market was going down, we're gonna have someone's coming in as a buyer. I don't think that exists. It's not like the central banks are out there, except for maybe in Japan. Central banks in the U.S. aren't buying equities, right? They might get there one day, but they're not going out and every time the market goes down, they drop. But the joke nowadays is every time the market's down 50 bips, you get some central banker making a statement, right? And to your point, that's sort of the idea of narrative economics, which is, do central bankers even have to take action anymore, or can just via sort of this narrative policy channel say, hey, we'll do whatever it takes. We're not telling you what that action is, but we will do whatever it takes to stabilize markets. And that's enough to actually stabilize markets itself, because participants go, okay, I'm willing to step in and buy here because I know the Fed's got my back. I think there are some ways by which, even just in the limited, I'm going to use air quotes there because probably the Fed has unlimited things that they can do, but in the somewhat limited standard tools that the Fed has, you might say, well, they're really only interacting with the treasury market. But we need to sort of consider how that plays out through all other markets. That if you can stabilize the lending markets, what does that mean for people being able to take credit risk, being able to take equity risk? What does that do for the stability of businesses to be able to borrow, right, and use those credit facilities, whereas prior to that, they may not have been able to, and they would have gone bankrupt. So I think those stabilizing effects that central banks can have, yes, narrative policy is an important part, but we have to consider the sort of the second and third order impacts of their actual actions to see how they stabilize markets in general.
And then, like we've now seen this their policies for a longer time, like maybe since the great financial crisis. I think they really amped it up. And you're sort of thinking about what does that mean for like how my behavior changes, right?
Yeah,
Yes.
I think so. There's an interesting. I think we can sort of get the clue here by talking generationally, right? When I talk to my parents about what their mortgage rates were and what they were able to get by putting money into a savings account, it's tens of percentage points above what I'm able to get, right? So today, if I make money and I go to save it, there really isn't a whole lot of benefit for me of putting money into a savings account anymore, right? Because there's just no return there, especially after inflation. So what am I going to do? Well, I'm probably going to put it into some sort of investment vehicle. And so we've seen this huge growth in sort of markets as an investment vehicle, right? You look at something like target date funds, for example. They've grown from a billion-dollar industry to a $1.5 trillion industry over the last 20 plus years. And I think there's sort of two interesting avenues of thought here. The first is, okay, what happens when the world just generally wants more equities, right? Supply and demand, there's the same amount of shares available, but there's more people who want to take their savings and now buy investments with that savings. What does that do? Well, that should, in theory, drive up, right, the price of markets. So we might see, stocks and bonds trade at historically high valuations because the demand is higher. The second interesting sort of perhaps more conspiratorial avenue of thought here is what happens when the world starts using markets as a savings vehicle and markets become volatile. Well, through sort of what we would call the wealth effect, right, which is that people are going to change their behavior based upon how secure they feel and how wealthy they feel. If I look at my savings all of a sudden drop 30% in a month, what's that going to do to my consumer spending, right? And so this idea of the Fed trying to move away from markets and become less of a player and go back to becoming a referee, I think is really, really difficult if we believe that because of the markets becoming a savings vehicle, the economy and the market has become more tightly linked than it ever has before, right? And so we see central banks being more willing to step in periods like March, because I think they recognize that as the market becomes more volatile, the consumer is going to back away, and that's going to have very, very important knock-on effects within the economy. So it's no longer that the market is sort of a forward projection of the economy. Now there's a true feedback loop because the market has become the savings vehicle of the economy.
And at the same time, becomes so strange because I know that the Fed knows that that they have to step in, and then
right.
I think, oh, I have to lever up.
Yeah, exactly. It becomes, I know that you know that I know that you know that I know.
Yeah. That's strange. I mean, maybe in history, the housing market's been a little bit like this because I think consumers got a lot of confidence out of how strong the housing market was. But I don't hear about it as much anymore, but still quite a bit. What do you and like this passive investing trend? Because I know you also incorporate that in your view. Is it a real important piece, or?
So there's really like three pieces in the liquidity cascades paper that I wrote. So we touched on two of them already. One is the influence of central banks. The second is this growing scope of volatility, contingent strategies, and the pro-cyclical impacts they can have on markets. For that second piece, by the way, I would really recommend folks who are listening check out publications, people from Chris Cole at Artemis Capital, Veneer Bansali, Ben Eifert has done a couple podcasts with Bloomberg that I think have been phenomenal on this topic. They are great thought leaders in this space. I definitely recommend it.
Is that where they talk a lot about like the structured products?
Structured products, influence of risk parity, CTAs, there's second order effects that they can have, knock-on effects into each other. They've done a lot of research over the years into these types of topics. So people are interested in that. I actually, after publishing the paper, created a web page for the paper where I list a lot of those types of references. So people who are looking to dive into these topics, we can actually probably share that link and they can find those
yeah, absolutely.
Papers.
Put it in the
so the third piece that you just brought up is this idea of the growing role of passive investing in the markets, right? Is it possible that everyone moving from active to passive is potentially distorting markets? And this one's really hard to figure out from an actual data perspective. It's definitely not obvious. The argument is more philosophical in nature. But I think what's important here, and this argument has really been proposed by Mike Green at Logica. And again, I link to a lot of his work. Mike has really been on the vanguard of this topic, pun fully intended there, by the way, for the last couple of years. And I think the real, at least, cornerstone of the idea for me is thinking about what is the difference in the way markets operate when markets are discretionary active versus when they're sort of indexed or passive. And so let's think about what happens. Let's say I want to invest $1 with you, and you are a traditional discretionary fundamental manager. So you wake up and you look at your cash report in your mutual fund, and you've got a new $1 in there. And you say, good, I get to put this $1 to work. Let me look at what's in my portfolio. Let me look at what's on my sort of hot list. Let's see what I want to buy. What's undervalued today? And you go and you put that $1 to work. And it expresses to the market, when you put that $1 to work, it expresses a view that you think that security is worth buying. You have more demand for that security. And so the market should incorporate that, and the price of the security should go up. Now let's consider what happens when I want to go to you and you're an index manager. So this is either truly passive or you are like an indexed ETF. So this could be like a smart beta ETF. Well, if I give you that $1, all you're going to say is, okay, what are the weights in my portfolio? Let me look at these and let me go out and buy all these stocks in proportion to the weight. And there's no view being expressed. I just want to buy that basket as cheaply as possible. Now, if that's a value basket, in theory, you're expressing a relative preference for those value stocks over the rest of the market. But within that basket, you're not expressing a view. Now, what we need to recognize is the securities within that basket are going to drift in their weights. They're not static, right? And that drift is going to be proportional to their relative performance. The stocks that have outperformed, their weights will go up, and the stocks that have underperformed, their weights will go down. So when I give you $1 today, you'll buy that basket. If someone else gives you $1 tomorrow, you're going to buy that basket, but more of the stuff that's gone up and less of the stuff that's gone down. Someone gives you another $1 the next day, you're going to, again, same basket, more of the stuff that's gone up, less of the stuff that's gone down. And so the question is, yes, that basket as a whole may represent a preference. But if we move from this true discretionary active of buying underlying stocks because of their fundamental valuation or whatever other factor we're looking at, to a basket-based market where those baskets are allowed to drift in between rebalances, right? A lot of these smart beta ETFs only rebalance once or twice a year. Does that introduce, from a supply and demand perspective, a divergent momentum-based trade? That every time new demand is coming into the market, it's more and more demand for the stuff that's recently done well. And can you get, as the market moves from active to passive and active to indexed, including all this smart beta type stuff, Does that represent potentially a structural risk in the way security pricing actually unfolds in the market? It's harder, I think, to argue that that is a sort of risk, a systemic risk from a, the market's going to collapse, but it would argue that you could see real runaway prices, right? In the mega cap growth names, if markets move entirely into this process and all demand is continuing to go in an outsized manner, in a growing manner to those names that have continued to outperform, you could see a real divergence between winners and losers.
Right. So when I read your paper, I think you also made a point like once you have a basket like that and there are like dividend paying stocks in them, and those tend to be like more on the value side of things, that it actually gets reinvested in the whole basket, which is already biased towards momentum, and that
so
fuels it again.
I should be clear for anyone who reads the paper. The paper expresses a lot of different ideas, none of which, well, not all of which I have equal confidence in. But I really, the dividend one was a fun one to sort of say, okay, at the extreme, this sort of concept could be possible, right? So if I buy a passive index, right, what happens is those stocks pay dividends, and then that index pays out the dividends to me, right? Now, let's say I don't want the dividends. I want to reinvest them. I go back and I buy more shares of the index, and the index manager goes and buys the shares proportionally. Well, let's pause for a moment and think about what happens when a stock pays a dividend. Well, we know the company's lost X dollars of cash per share. The shares should go down by X dollars, the amount of the dividend paid. So if you have all these stocks that don't pay dividends and all these stocks that do pay dividends, what that means is, let's assume there's no other price movement. Every time the dividend gets paid, the stock that pays the dividend goes down in value. And so when that money now gets sent out and reinvested, the relative weight of the company that was paying the dividend has gone down relative to the ones that don't pay a dividend. And so again, from a supply and demand perspective, you're going to demand more of the stuff that didn't pay a dividend. And so you have, and so what's interesting is, right, the higher yielding stocks tend to be more value names. And so if this dynamic were unfolding in actuality, you would say, well, then all these sort of high yielding value-ish stocks would be the ones that are continually seeing their demand erode relative to non-dividend payers, high reinvestors, because of this pure flow dynamic as we migrate from a more active to a more indexed or passive investment society.
Yeah, and you found it to an extent, right? Well,
so what I took a look at is I said, okay, what happens when we look at high yielders versus low yielders? Okay. And what you find is that historically high yielding stocks have outperformed low yielding stocks because, again, it's been that value tilt. That was true up until sort of the mid 2010s. Value has really struggled since then, but it hasn't been true if you look at no yielders, so companies that don't pay any dividend versus higher yielders. And what you find is that's just sort of a disaster of a chart. But in the early 90s, suddenly becomes almost like a straight line down, that high yielding stocks have just dramatically underperformed no yielding stocks starting in the 90s and in sort of an accelerating fashion. It would have been an absolutely brilliant trade to put on if someone could have discovered it and stomached it. I thought maybe it was just like the Amazon effect, like, hey, we should all, Amazon was sort of the outlier that was driving this. This effect held true whether I measured it cross market, right, always buying the no yielding stocks and shorting the high yielding stocks, or intra-sector, so neutralized for sort of industry effect. It wasn't just sort of an overweight tech, underweight financials type trade. And so it really does seem to suggest that, right, the no yielding stocks have just outperformed. Now, whether that's because no yielding stocks have benefited from low interest rates because of central bank pressure, or they tend to be the ones with better economic moats, or higher yielding stocks are old stodgy businesses that can't compete anymore. There's all sorts of narratives here. Maybe it is the indexing effect. I don't know. And that's what makes this so hard to disentangle. But again, thinking to extremes of what happens when we go pure indexing, these are the sort of distortions we would expect to see.
Yeah, if I'm thinking from like a fundamental perspective and to add a narrative, I think maybe buybacks became better known around that time, and I think
Yep,
like better managers may have um, utilized those more because it can be more effective. And
absolutely.
I think maybe the very high yields, I also see this element where like yield chasers get exploited a little bit by companies. And
Yep.
yeah, then they don't do a mix between buybacks and
Well, what's certainly interesting from a fundamental perspective is I'm starting to talk to fundamental managers who are trying to incorporate these ideas into what they do, which is saying, let me find the fundamental businesses I like
mhm.
and then figure out who is going to be the buyer, right? Because at the end of the day, you want to buy something at a discount, but if it perpetually stays at a discount, that's not useful to you. You need to stay at a discount and then ideally have a reason why someone else is going to reprice it upwards. And so maybe, yeah, if it's at a discount, you can just harvest higher yields or whatever it is. But ultimately, right, you want that repricing. And so it doesn't help you if you're buying a stock that doesn't exist in any index. It's a complete orphan. Well, where's that flow going to come from that reprices it upwards? And so these are sort of some of the interesting discussions I'm starting to have with fundamental investors. Or the other way you can sort of go is say, I'm going to be a fundamental investor, but I'm really going to either need to see a catalyst for repricing, or it's a sort of fundamental approach that I think the repricing is going to occur because of M&A activity. That something's either going to be taken private or bought out, and I'm not going to care about the price between that period.
Yeah, I've had to gravitate towards all of the latter. In valuers like or fundamental investing, like a lot of you're probably aware of this, but all these schools of thought, and I think historically it's actually really great if you buy like the melting ice cubes that have no catalyst, because those are the absolute cheapest, and it will work out over time, but the last 10 years, I think that's been like the worst kind,
Yeah.
for me at least. Um, Maybe are you aware that a firm called Horizon Kinetics did some work on like passive investing in ETFs a few years back?
I know the name Horizon Kinetics. I don't know the piece you're referencing.
Oh yeah, they did like a, um, a number of essays all on passive investing. But I think a few years back they kind of um, they started to do some other subjects because ETFs were just continuing to grow. But one of their points was how they are constructed, which I thought was really interesting. Is that if you want to launch an ETF, it's a little bit like launching a fund. But what you have to have is like a back test of your strategy. And so their point was you can only sell that ETF if you have a strategy that backtests well. So you can only include stocks that backtest well, which is our momentum stocks.
Right.
And yeah,
I think it's a great point. So it's this actually is a little insider baseball for people who aren't in the fund industry. You cannot show a back test for a 40 Act fund. So a 40 Act fund being a mutual fund or an ETF. You actually cannot show a back test for an ETF. What you can do though, and this is like where everyone gets around the rule, is you can say an ETF tracks an index.
all
And
right.
then the index publisher can publish a back test of that index because the index publisher is not regulated in the same way that the 40 Act vehicle is regulated. So there's all sorts of ways in which the market, in which people are able to market a back test, even though they're in theory not supposed to by sort of FINRA rule. I am not sure about whether that how that index can show up in the actual marketing materials of the ETF itself. But again, most people just go to the index provider and look up the index. And to your point, right, this is probably the worst thing we as quants ever did was give the marketing team a back test. Because if you talk to any quant, they'd say, well, a back test has got all these sorts of flaws. But when you give it to a
Yeah.
marketing team, they go, well, we can really jazz this up, right? And so to your point, it's just going to reinforce building strategies that worked with prior winners and keep inviting buying those prior winners, which creates this distortionary momentum-based flow. So I think that's a really interesting point.
Yeah, yeah. I'm based in Europe, and the rules are different, and I actually have to like include a back test, and well, maybe not, but maybe also based on an index or ETF. But and all financial industry were complaining about it because it goes back 5 years, and like last year, those 5 years were great.
Yeah.
But then you were promising people like, yeah, it's 14% annually. Well, everybody knows it's not
Well,
real.
it's like the disclosures that say past performance is not indicative of future returns, but everyone wants a back test. So I don't know how we square those.
No, it's hard to do. Hard to do. Corey, this is great, but I wanted to maybe talk about you figured or you put all this together, these pieces, and then you figured out trend following is not enough. I need more. And you looked at, I heard you explain it before, that you looked at all these pieces. And to me, that means that you looked at everything where there's academic research, because you've been always been doing trend following, so you don't have like experience like a trader or something that you can implement.
Yes. So I actually, at our firm, despite being long-term trend followers, we've been publishing research fairly consistently in all sorts of different topics over the last 5 years or so. My view has always been if you can think laterally, it helps sort of take those blinders off. And so we would do research and write research on factor, equity selection or tactical trades in credit valuation. All of this, again, not necessarily incorporated within our portfolios, but purely to help us try to get out of our own avenue and think laterally so we can try to incorporate ideas that might spark some sort of innovation in our trend following programs. After publishing this paper, I took a step back and said, okay, I think this is all very suggestive that the efficacy of trend following is going to be slightly reduced over the next 5 to 10 years, as long as these features remain mainstay in markets. And so I think that means I have to have a difficult conversation with my clients, first and foremost. But second, I need to go back to the drawing board and thinking about how, again, if our objective is to create a resilient equity portfolio that can try to participate meaningfully and cut the drawdowns, how can we actually achieve that? And so what's funny for me is at the end of the day, the philosophy for us didn't really change. We have long said to our clients this idea that risk is never really destroyed, it's just transformed, and that there's all these different ways in which you can manage risk, and they all have different pros and cons, right? You can buy fixed income, you can buy trend following, you can buy alternatives, you can buy puts, you can buy some really esoteric tail hedges, and they all have different trade-offs in terms of when they're going to kick in, what type of convexity they have, how certain you are they're going to work, what do they cost. And so I'd always said to my clients, we should just be a piece. We're the trend following, you need to do all this other stuff. What we took a step back to say ultimately was, well, we're just now going to do all this other stuff. That if we want to build the ultimate sort of resilient equity portfolio, we need to be resilient to the full breadth and spectrum of equity outcomes, which means not only fat left tails like a March 2020, but fat right tails like a 2017 or 2013, where you get these sort of 2-3 standard deviation outsized years. And so what we did is we took all those core concepts and wrapped them together. So instead of just sort of having a pure trend following strategy, we said, okay, we want trend following, but we also want a slice of the portfolio that's focused on growth. So we want to put momentum equities and out of the money call options together, right? Really try to create that outsized convex right tail participation. And then for the left tail, right, we're going to want some defensive quality low vol names and combine those with out of the money put options on the market, right? Try to create that convex left tail exposure. The tactical sleeve, which is about, so these are all going to be a third, a third, a third, serves as sort of your dynamic pivot as to how much beta you have in the portfolio. And then finally, we wrap the whole portfolio in treasury futures, in active treasury futures mandate, because I still think there's value in fixed income. It's just that you have to be capital efficient in how you access it, right? So there's still diversification and a little bit of carry and yield that you can generate that can help offset the cost of the puts and the calls, and it's potentially a second diversifying source of returns. And hey, maybe it does have some flight to safety qualities that you can take advantage of in a crisis. But when you're selling equities to buy fixed income, that's a big return gap to get over. But if you can layer fixed income on top of your equities, sort of do what the old modern portfolio theory sort of said, find that balanced portfolio and lever it up to your risk level, I think that's a much more efficient way to try to incorporate that risk management tool. So that's ultimately sort of the full picture.
And that's sort of a risk parity element to the picture, or?
Well, it's a little less risk parity. If you're doing real risk parity, you'd have about 8 times the amount of fixed income to equity. This is still very equity dominant. The idea is, hey, if we can add another 50, 60, 70% notional exposure to the fixed income, it's still meaningful as a return contributor, but it's still an equity dominant portfolio.
And capital efficiency comes through futures markets that you
exactly
have to post few collateral.
Yeah, and because the volatility in Treasury futures is pretty low, you can have 3 to 5% collateral to get 50 to 70% notional exposure.
Right. So, and what do you think about the idea of, because I know for you this is really not a focus point, but if you can find like some kind of alpha generator, that's like the holy grail because it adds a little bit of return without the risk. If you can get that in there, it will be great. Are you just a non-believer or?
No, I actually, so for us, we are, I think, first thinking about this from a structural diversification standpoint. So one of the things I've said in the past and talked about a lot in our writing is that diversification is more holistic than just what you invest in. It's also how you make those investment decisions. So your process diversification and when those decisions are made. That's a whole other rabbit hole we won't go down, but that's a real passion project of mine, of that when diversification. For me, what we tried to do is look at that how are we making these investment decisions and focus on structural process diversification in the portfolio, right? So there's some not passive, but like structural equity exposure. We've got these convex left and right tails. We have trend following in the middle, and then we wrap the whole thing in a diversifying exposure. Doesn't mean we're not looking for some alpha though, right? Not only is there, I think, some potential for alpha in the momentum and low vol defensive names that we buy. We are ultimately looking for alpha over the long run there. But I think there's the potential for some rebalancing alpha, right? That can occur, that in a large market sell-off, if you can harvest, sell some of your fixed income, sell some of your puts to buy cheap equity, that's sort of more timing alpha that can occur. We would hope over the long run that trend following can still generate some alpha in a similar way and benefiting from that rebalance premium. So I think there's different types of alphas that can come in. I don't know if it's sort of the traditional, we're choosing this cheap stock and doing the fundamental analysis alpha, but I think from a total portfolio construction perspective, there's other ways in that alpha can find its way into the portfolio.
Right. So yeah, I think you can find it in a lot of different ways. And as I get older, I become more open-minded about how people generate it. So that's great. This is going to sound really stupid, but I'm actually not completely sure what the difference is between momentum and like trend following.
Oh, that's not stupid at all. So because they get used interchangeably all the time. So they actually both operate very similarly, where you're looking at past prices. Momentum just says we want to buy the stuff that's relatively outperforming and avoid the stuff that's relatively underperforming. So, and trend says we want to buy the stuff that's going up and sell the stuff that's going down, right? So if I have a momentum strategy, right, all the stocks could be going down. I'm just going to buy the ones that are going down less. Right. If I have a trend strategy, I'm saying I'm not buying any of them. Right. So that's the big difference. Trend to me is more of a risk management tool. It's more defensive in that nature, that you're willing to say, hey, I just don't want to make any investments. Whereas momentum is more of an alpha type strategy where you're trying to capture the relative performance between securities.
Okay, so, and on the long side, they are really similar, if I understand you correct?
So academic literature would say they're actually pretty similar. On the long only side though, so as a difference, right? So our momentum sleeve would constantly rotate into the names that have relatively outperformed, right? And so this sort of aligns with some of the stuff we talked about in the liquidity cascades piece, that if we do believe this move from active to passive and active to index is creating this distorting supply and demand type trade within the market, momentum would front run that. You want to just be buying the winners because those are going to keep going up. Trend for us, what we look at is the trend of the overall market and say, is the market going up or down? If the market's going up, then we just want some beta exposure. If the market's going down, then that sleeve can actually go all the way to cash. So it can help swing our beta from, call it 1 down to 0.7 or 0.9 down to 0.6 thereabout. So it can help dampen volatility within the portfolio and de-risk the portfolio when we see negative market trends.
Okay, that's interesting. So it's also sort of like a market timing mechanic based on.
Yeah, trend is a little bit of market timing. So I would, so this is like one of my soapbox issues where I would say everyone's a market timer, right? Your choice to buy an individual stock because you think it's undervalued. Well, that when you choose to buy it is a market timing decision. So anyone who's other than people who are just literally dollar cost averaging into the portfolio over time, everyone else is a market timer to a certain extent.
Yeah, definitely. I have noticed it first with the selling, like when you sell something, and we spend so little time on it that we do it really poorly. So some research that.
Yeah, I mentioned, that sort of third dimension of diversification, that when diversification. I mean, that is, I've published a paper on it, written a second paper. It is a hugely influential part of returns of when you buy and when you sell. You and I can run the same value strategy, but if I happen to rebalance at a different time than you rebalance, we can end up with some very different returns, which I think goes very overlooked in this industry.
Yeah, and also I saw some research that like fundamental professional investors, they actually were pretty good buyers, but on the selling they gave away a lot, and if they just randomized it would have been better.
That's interesting.
Yeah. So if I can summarize your new framework, it's actually that you combine like a trend portion still for if we're in a long bear market, then it works great. You have a meltdown protection with some puts and a lot of quality equities because the puts are probably quite expensive, maybe not always. For like what's working great this year is like momentum for when we're melting up, and call options, out of the money call options. Are you like buying out far out of, or you don't have to say what you're buying, of course?
No, so for us, I mean, the nice thing when you run a fund is people can go look at the fund holdings every month. So, it's not all that transparent. I mean, it's not transparent. So what we're mostly looking at for the puts and the calls right now is just a ladder, looking 11 months to 6 months in how we're blending our durations. And then we're looking when we buy at about 20 delta. So not super out in the wings, but sort of around the shoulders and both the puts and the calls. Again, the ultimate idea there for us is we're trying to do a fixed premium based approach. So rather than trying to cover a certain amount of the notional, we're saying, look, we want to buy more contracts when the market is underpricing risk and buy less contracts when the market's overpricing risk. So it's a little counter-cyclical in that approach. So it does mean, for example, after March, when vol is really high and put protection is really expensive, we're going to buy fewer contracts. So if the market kept going down, the puts would not have done much for us. I mean, again, they were priced in such a way that the whole house would have had to have burnt down before you got any value anyway. But the whole idea is we're trying to use, by focusing on a fixed amount of spend every month, we're trying to create a counter-cyclical approach to buying that optionality.
Right, and then the last part is you've called it carry, I think, and that's where you add the treasuries in in a future strategy.
Yeah, exactly. So there's sort of like, I think the very simple way to think about it is there's 3 pillars. You've got your defensive pillar, that's 1/3 of the portfolio, quality and out of the money, quality names, out of the money puts.
Yeah.
You then have your middle pillar, which is trend, It's just going to dynamically tilt your beta a little bit. Your third pillar is growth. So momentum names and out of the money call options, trying to create that right tail convexity. And then we wrap the whole thing in some capital efficient bond exposure.
Yeah. Corey, do I need to let you go right now? Do you have a few minutes?
No, we've got a couple more minutes. Absolutely.
Yeah. We talked about this before in the pre-interview, but when I saw your new framework, what stood out to me was how you avoided the deflation, inflation thing, and you told me, yeah, that's like a macroeconomics way to look at things, and that's not what you do. And I thought that was pretty interesting.
Yeah, there's a couple of points here. So first, I would say inflation is really hard to think about, right? Is it consumer basket inflation where we're seeing milk and eggs go up in cost? Is it asset inflation, right? Is it monetary inflation? So I think trying to hedge inflation is very hard. I would argue that for certain types of inflation, we actually have phenomenal exposure in the portfolio because of those out of the money call options, right? If you see certain types of inflation, those should actually do really, really well. That said, taking my investment hat off for a minute and thinking about what it means to run an asset management firm, we have to recognize that the way investors build portfolios tends to occur in a very siloed manner. So when we work with financial advisors, they'll have a part of their portfolio dedicated to US equities, dedicated to international, dedicated to fixed income and commodities. And when you start to build a product that overlaps too many of those concepts, the product actually becomes sort of non-saleable because it doesn't fit the framework by which they allocate. And so for us to continue to operate within the US equity framework, it had to be a very US equity centric portfolio. So that's just sort of the unfortunate reality of the way portfolios are built today and the way the whole distribution engine of the asset management industry unfolds. But again, this isn't meant to be the end-all, be-all, turnkey, sole solution portfolio. This is meant to try to be an all-weather equity portfolio. And so my view is it can be complemented very nicely with other positions that may do well in inflation. You could buy, for example, some gold or some Bitcoin if that's what you're into. You could buy some commodity trend if that's what you want. And I think there's all sorts of other ways that this can be complemented with other exposures that would do well during an inflationary environment.
Yeah, right. So you're not trying to solve every problem. Your framework is a building block. But what I thought was still kind of interesting that you don't look at the data like this is in a deflationary environment or inflation and use it as like an input. But that's
I know a lot of firms have sort of taken that Bridgewater quad-based approach, right? So they're sort of economic growth and inflation, economic growth, deflation, the four sort of quads, and they've tried to map different investments to it. I think again for us, I haven't, at least in my view, found a great way to map economic regimes. I know some firms claim they have. I haven't in my testing been able to do it. And I also find personally that when I start to look at a lot of the macroeconomic data, it's so delayed compared to what's actually going on in the economy, and trying to figure out sort of the actual machinations of the economy, right? There's so many first, second, third order effects that are going on. I find it to be very murky territory that I don't have a high degree of confidence in. So when it came for me trying to think about from a structural perspective, building a strategy that's got internal process diversification, macroeconomic views didn't really fit into that framework for me.
Thank you. It's great to have your opinion on this, because I thought it was really interesting, and I've seen the quad approaches, and how it helped me was that I could like think through like what are potential regimes that we go into, and then you look at like, hey, which asset classes do kind of fine all the high
Mm,
probability regimes, and then as another step is like, and how expensive are they?
right.
There's some inflation assets that are, we've had no inflation for like 10 years, so they're cheap. And like some deflationary assets like the tech stocks, they, I could argue they're pretty expensive. And so yeah.
And I think what becomes really hard too is, to your point, like when was the last time we saw a real inflationary regime? So
Yeah.
are you looking at
80,
back-tested
82.
history to say what you think is going to do well, or is this sort of a fundamental view you need to build? Because again, I would argue markets have changed.
Yeah.
Gold back in the 70s and 80s was a very different asset class than it is today.
Yeah.
There's a really fascinating paper that got published by Cam Harvey as one of the authors, and it's all about this idea of massive passives, which is what happens when you commoditize access to commodities. If all of a sudden you can use an ETF to buy gold, how does that change the way gold is priced?
I
And
think that had an effect.
what they found in this paper was that gold no longer is all that responsive to real yields. Gold is now almost purely responsive to supply and demand within the ETF itself. And so it becomes, again, the question is, okay, am I buying gold because I think it's an inflation hedge? Well, I think a lot of the new evidence would suggest that in this type of commoditized access regime, that no longer is gold all that tied to real yield. So these are
Yeah.
interesting dilemmas that, again, I think are worth researching, but make it very hard for me to look at the quads and say I have a high degree of certainty that certain assets are going to do well. Again, diversification works. You can buy a whole group of a basket and they don't all have to work. But for us, again, focusing purely on trying to build all-weather equity, I think momentum helps us constantly tilt into the names that are winning. If we enter into an inflationary regime, the winning names will be those that are less sensitive to inflation. Quality, again, always being on the defensive side of that, building those structural puts and calls, having that dynamic trend. Again, it's all about not trying to focus on what is going to be the single approach that works, but trying to find a blend of approaches that'll be resilient in all markets.
Yeah, no, I think that's a great approach. But I'm always curious, what you're really thinking about something, or why you didn't. Sometimes you have an opinion on something, but you can't execute it because you're not confident enough, or something like that. I do that all the time. And so maybe one thing I wanted to get your opinion on, because it's sort of a weird thing. There've been these institutions, and they did. It's these call overlays, right? They sell calls on their portfolios, and that's really popular. So those calls are probably a little bit underpriced. But I've been thinking maybe that's also a really great way to deal with some of these the influence of like Wall Street bets on the market. I don't know if are you familiar with that debate?
I am. So this is a really interesting topic. I mean, I think sort of the joke name is the market sort of become this call option casino, right? But what you're talking about is two interesting effects. So post 2008, right, a lot of the growth of factor and style premium investing, one of the big ones was the variance risk premium, or the volatility risk premium. And the idea was that you could go and you could sell optionality, and you could harvest a premium that is somewhat diversified to the equity risk premium. And so a lot of institutions began adopting covered call selling on indices, right? So they'd sell 1 or 2 month 25 delta calls on the S&P 500. And this grew and grew and grew and grew, and is still very large today. And so what this actually does is it, in theory, creates volatility suppression within the market, and potentially even what we call pinning effects. So how does that happen? Well, when the institution sells a call, there's got to be a buyer on the other side. And very often that buyer is going to be an options dealer who's acting as market maker. They're facilitating the trades. Now, they're long a call option, but they don't actually want to be long a call option. They don't want any directional exposure. They just wanted to make the market. Now they can try to lay off that call option on someone else, but what they're actually going to do is hedge that exposure. Now, what's really important to understand here is to hedge that exposure, they need to short the underlying market. And as the market goes up, they need to short more. As the market goes down, they need to buy back their shorts. And so what this does is every time the market goes up, you've got all these dealers selling. Every time the market goes down, you've got all these dealers buying. So that's what's happening at the index level. And if you imagine that the amount of covered call selling has gone up, you're now talking about tens of billions of dollars coming into the market to buy and sell every time the market moves 1%. So big influence. Contrast that with what's going on with like Wall Street bets, where you have a lot of people buying super short-term speculative call options. And again, so they're not selling them, they're buying them on individual names, right? So Tesla call options. If enough people do that, and it's important to remember these are levered trades here. All of a sudden, all these people are buying 1 week out of the money calls on Tesla, and you've got a dealer on the other side who's now short the call. Well, now the dealer has to make the opposite trade. The dealer is now forced to buy the stock. And as the stock goes up, they need to buy more. And so it ends up in this sort of self-fulfilling, if there's not enough supply, all these dealers demanding stock drives the stock up, forcing them to buy more stock, driving the stock up. So you have these sort of two countervailing forces here. You've got the index level, a ton of suppression, and under the index, all this call option buying that is in theory driving some of these mega cap growth names well beyond any sort of measure of fair value. And I think this is one of the things that when I talk to like true fundamental investors, many of them don't even realize is going on. That huge rally in July and August among tech names, in retrospect, seems to be almost entirely fueled by call option buying. That there were days that volume in names like Apple seemed to be 25% driven purely by hedging of these option dealers. And so it's, again, this is a new emergent dynamic in markets. And maybe it goes away. Maybe once sports come back, all these people will stop gambling on stocks and they'll go back to gambling on sports. Or maybe it's just the way markets operate from now on. That options have become the tail that are wagging the dog of the underlying asset. And we need to sort of square how that's actually going to impact portfolios going forward.
Well, I read Wall Street Bets because this was killing my shorts. And well, I think they're real concentrated in some of these call positions, and yeah, you get wiped out at some point.
Well, and that's a great point.
While.
This is not a perpetual money-making machine, right? What happens is as they keep buying these calls, the implied vol goes up in the calls become more expensive, they can buy fewer contracts, that creates less hedging pressure for the dealers, but also at a certain point, they just are wrong and they lose all their money, right? And so once they get wiped out, it's hard to come back in size.
And the premium of the calls becomes really expensive.
Very expensive, right? So that hurdle rate for them to get over to be profitable goes way up.
Yeah, but I was thinking I could maybe exploit it when they go after a stock that I actually think is a good stock, so I can own it and then sell the calls when they're overpriced. But then the stock's already run up.
Right.
I can't figure it out.
Well, and again, this is so the ways in which we talk about how our market's different. They are definitively different than they were 30, 40 years ago. A lot of people are drawing similarities to the 90s and saying this is sort of how it was in the late 90s, that you can get this speculative bull market fueled by levered derivative trading, and it can go on for another 2-3 years, far beyond what seems like fair value. But this could still be early innings in this type of influence. Yeah.
I used to play poker professionally, and to me it is a little bit like 5 years ago I was studying how do institutions operate, what do they do in markets, and how can I avoid their mistakes. And now there's Wall Street bets, and you're like, how can I deal with this? But
Right.
last question, and I'll let you go because I've kept you way over an hour. Like, are you thinking about now? You've got this new framework. Actually, you adapted from your old one, and are you thinking about what could unwind this whole new regime, or what are you looking for signals that would tell you like, oh, I need to go revert back? Or
Yeah, I think what's important is, and the way I sort of mentally operate is starting with this do no harm framework, right? So first and foremost, let's assume I'm wrong in everything I've said in this podcast, right? I'm wrong in my liquidity cascades piece. I'm incredibly convincing. I can spin a great narrative, but all the data is just wrong. And so when we were rebuilding our mandates, right? And this took time. I should mention, like, we started doing this research in March. We became very convinced of what we were seeing in June. We started trying to make updates to our funds in July, trying to take an existing 40 Act vehicle and make some of these changes. Operationally, it takes time. And so we didn't actually end up implementing these full changes until just before Thanksgiving here in the US. So sort of second to last week of November. But so all that aside, when we were looking at rebuilding this, I said, look, we need to start with the assumption that I am just completely full of shit. We need to start with this do no harm assumption that even if I'm wrong, would this still be a portfolio I want to own, right? Do I still like a portfolio that's a barbell between momentum and quality stocks, that has some right and left tail convexity, that I'm not just, buying wildly, but I know what my fixed spend is? Do I want a little bit of trend following in there? Do I want capital efficient exposure to bonds? Well, this was in effect what I was arguing clients should have been holding all along. I was just saying, I'm just going to give you the trend following piece. You need to build out all the other pieces. Well, now all we've done is we've said, we're just going to build out all those pieces for you. And I think we'll continue to evolve and innovate upon how that particular structure works. But I think, again, it's still a good all-weather resilient portfolio. Now, I think the opportunities to exploit the current dynamic, right, might argue why you might want to buy puts or calls at certain deltas or certain maturities right now, or why they might be structurally cheap or expensive. Ways in which you might want to look for signals within quality or momentum that might be different than different regimes. And so for us, what we're ultimately looking at is we're looking at how influential are option dealers. Can we try to measure the actual impact they have? How over or underweight risk parity and CTAs and all these volatility targeting indices, how over or underweight are they in equities at any given time? How much do central banks seem to be influencing, right? If central banks start stepping away really proactively, which I don't think is going to happen, but if they do, right, I think it suggests that these dynamics might be different. I think it would be very hard for these dynamics to unwind rapidly within a year. I think it would take 3, 5, 10 years. And so I think these dynamics will stick around, but we are trying to keep our eye on all these things. But again, even if we're wrong, I still think structurally the portfolio we've built is a good all-weather resilient design.
Right. Yeah. Okay. So I think this was a fantastic interview. It was super interesting to me, at least. If people want to read, I mean, you have written multiple really interesting papers and a great letter. Where can they find your stuff? And
yeah, well, and thank you for having me in the interview. It's been a ton of fun, and I appreciate the opportunity. You can find me on Twitter at C Hoffstein, which is how we connected. I have a podcast called Flirting with Models that's very quantitative in nature, but if you're interested in options and derivatives and factor investing, done 3 seasons now. And then you can find the written work that I've done at our website, thinknewfound.com. You'll find a link to the Liquidity Cascades page that's got the paper, as well as all these sort of supplemental information and other links to other papers and research blogs that we're doing.
Thank you, Corey, and thanks everyone for listening. If you enjoyed the podcast, please like it or subscribe, whatever platform you're on. Thank you very much, and see you next time.